Right, so the last couple of days have been absolutely crazy in the crypto space, but also not just in the crypto space, it is also related to the global economy, the financial markets, with banking collapses, with the potential for a more contagion spread in the week ahead. So I want to catch you up to speed on everything that has happened in the last couple of days. I want to keep it short and sweet and concise and factual to help you understand what has been happening and what could be happening next week and the next weeks, and how you can use this information potentially to position yourself better in these markets. So I want to start out by saying that the charts, in my opinion, always show the way, and the news and the fundamentals always come out after the fact. This is something I've learned many years ago, something that I continue to say and will continue to say, because it is all based on price action on data. And if you know how to read charts, you can identify potential reversals before the news starts to come out. And most people only react to the news, and they think that the news causes the sell-off in the markets or the pumps in markets, but it doesn't. The charts lead the way before the time. So I would highly recommend investing time and resources in yourself to learn how to read charts, because it can give you an edge on what is going to happen before the masses start reacting to the news that eventually comes out after the fact. And to show this to you, I want to share with you here. On February 19th, I posted this on Twitter. I'll add the link down below. But you can see the divergence was already there. This is a daily chart. There is a negative RSI divergence in the same way that it started appearing before the top in May of 2021, before that massive drop. Also, before the second top here by the 69,000 in November, we had that negative divergence, as you can see, followed by the entire bear market, really. And as you can see over here, we started to get this negative divergence as the price was hitting that $25,000 level. It was also the August resistance, and if you look on the weekly chart, I shared this in previous videos at the time, it was also the 50 and the 200 week moving average right there as resistance. So the chart was already showing that there was a decent chance of the 25,000 being some sort of local top, and us at least getting a pullback, if not a deeper reversal. And as you can see, we are now here on March 11th, and the price has already dropped back to 19.5 thousand, which by the way is an important level because it is the 3-day 50 moving average, something I'm watching as support for the bulls. But let me walk you through the news and the chain of events first, and then we'll go back and look at the charts in real time. I'll share with you my thoughts on what I think could lie ahead that way. But it's just interesting to see here that the charts lead the way, then the news tends to come out. So with that in mind, let's move over to what has been happening. So earlier this month, we had a crypto bank called Silvergate that is basically collapsed. And one of the things you should know about Silvergate Capital is that it was the banking partner with FTX, you can see. And the bankruptcy of FTX, which as you know happened last year in November of 2022, FTX was one of Silvergate's customers. On November 11th, saw the bank stock slide pick up pace. So basically Silvergate Capital was part of the crypto space tied to FTX, and that collapsed. And that was obviously not a good thing. But that is not what this is about specifically, because there was actually another bank that has collapsed recently. So you can see here the statement on Silvergate liquidation. The Senator Sherrod Brown said, as the impact of FTX's collapse continues to ripple outward, we are seeing what can happen when a bank is over-reliant on risky, volatile sector like cryptocurrency. So obviously here they're pinning it on cryptocurrencies, obviously because it was tied to FTX. But what happened now extends beyond FTX, because we have a bank called Silicon Valley Bank. How does a bank collapse in 48 hours? So this is basically, I'll link to all these articles and resources down below so you can check it for yourself. So SVB was founded in 1983. It specialized in banking for tech startups, and it provided financing for almost half of US venture-backed technology and healthcare companies. So this is a really big bank. Actually, it was among the top 20 American commercial banks, right? So this is a big deal. This is not some random little bank that is working with a crypto exchange. This is a huge bank, top 20 US bank that went under in less than 48 hours, okay? It had 209 billion in total assets at the end of last year, according to the FDIC. So why did it fail? Well, In short, SVB encountered a classic run on the banks. The longer version is a bit more complicated. So a run on the bank basically means banks do not keep all the customer deposits in cash. In fact, they run on something called fractional reserve banking, meaning they only need to hold a very tiny percentage of the customer's deposits. So if they have, for example, $1 million in customer deposits, they hold only a fraction of that, maybe $10,000, maybe even less. The rest is all either invested or lent out and being used by the bank to make more money for the bank. That is how it works. So in theory, if there's that $1 million, but there's only 10,000 available, if all the customers go to that bank and say, hey, I want my money in cash now, it's just not possible. And that is actually the status of all banks in the world today, which is in theory a problem, because if there is a panic and regular people like you and me go to the bank and say, hey, we want to withdraw all of our money, and enough people do that, the cash is literally not available, and it would grind the whole system to a halt, or at least force them to start limiting withdrawals to X amount per day so they can sustain it. This is a problem about the current banking system, the fiat system, the financial system as we know it. Okay, so back to SVB. First of all, there was the Federal Reserve. They started raising interest rates. They've been raising interest rates at the fastest pace in 40 years. Okay, so that means that money gets more expensive to borrow, which when people are exposed to borrowing money or want to borrow money, it becomes more expensive. The arbitrage doesn't work. It becomes less profitable, and it can really start to break things. Okay, so the Fed moves aggressively. Higher borrowing costs sap the momentum of tech stocks that had benefited. Of course, when the money was cheap, when it cost almost nothing to borrow money, lots of people, companies, businesses borrowed millions, tens of millions, hundreds of millions of dollars because the interest payments on that were so low that they could use that money that they borrow, make a lot more, pay for the interest payment, and be profitable. But when the interest rates start to rise, that's no longer possible. And then, of course, the banks take a hit because they're no longer having all these people take out these loans. Okay, so higher interest rates also eroded the value of long-term bonds, and other banks gobbled up during the era of ultra-low, near-zero interest rates. So they were invested in bonds, and at the same time, venture capital began drying up. Again, not much money available, it starts reducing, there's no more money being splashed around, and then everything that was working so fine when there was lots of liquidity and lots of cheap money now is no longer the case. And then people who overextended, who used leverage, who took bets with money they can't afford to lose, they're going to start to have issues. So the panic takes root. On Wednesday, SVB announced it had sold a bunch of securities at a loss, and that it would also sell 2.25 billion in new shares to shore up the balance sheet. The bank stock began plummeting Thursday morning, and by afternoon, it was dragging other bank shares down with it as investors began to fear a repeat of the 2007 and 2008 financial crisis. And by Friday morning, trading in SVB shares was halted. It had abandoned efforts to quickly raise capital or find a buyer. California regulators intervened, shutting the bank down and placing it in receivership under the FDIC. Contagion fears subside. Okay, so this is basically what happened. This one of the top 20 banks in America basically became insolvent, and now there is the fear that this could potentially have contagion for other banks. This extends, like I said, way beyond crypto because it's tech companies. It's other companies outside of crypto that have nothing to do with crypto who are now having severe issues. If this bank is in receivership, sure, there's FDIC, but that's up to $250,000 per account, as far as I know, which means that even eventually, if they get the money back in the short term, if they don't have other solutions, how are they going to make payroll, how they pay their employees? This can cause a lot of problems. And then if other banks start to have the same issue, people panic, they start to withdraw money from other banks who are then also undercapitalized or maybe don't have that cash available or exposed to risky investments. This is just basically a house of cards or a domino effect that could get a lot worse. And we might be potentially looking at some sort of major flash crash like we saw in March 2020, where everything just sold off in a massive way before the central bank stepped in and started printing more money to be able to bail everyone out. Similar thing happened in 2008. Remember, it was Lehman Brothers that collapsed, and it's a domino effect. Once it goes, the rest can go very, very fast because they are all, or many of them have a similar issue where basically they were able to get away with it as long as things were good. But once things start going bad, it just, it it can spread very, very quickly. So that is what we're looking at in terms of this. So what is happening with cryptocurrency? Well, as a result of the SVB bank failure, we have Circle, which is the issuer of the stablecoin USDC. They confirmed that they have $3.3 billion in cash of the 40 billion USDC reserves that are in the collapsed SVB, in the Silicon Valley Bank. And as you can see over here, they officially confirmed this on their own Twitter account. So what this means is USDC is supposed to be backed one-to-one by reserves. So anyone who wants to redeem one USDC should be able to get $1. And the idea behind this is that it's regulated, it's fully audited. So in theory, there's no fractional reserve banking, and every single customer of USDC should be able to redeem all of their USDC and get cash back. Okay, so that is how it's supposed to be working. But now, if $3.3 billion might potentially be either locked up or a part of that lost, or maybe all of that lost, it means that USDC is no longer backed one-to-one, and that created this panic that we've seen over the last couple of days, where people start getting fearful. As you can see right now, USDC coin is actually trading at 0.96. So if you have one USDC, you're supposed to be able to get $1 exactly to redeem it. But right now you can get only 96 cents. And that actually dropped as low as already 87 cents. Meaning that if you had USDC and at that very low you were to sell it, you could only get 87 cents back on the dollar, meaning a 13% loss. Now, it has obviously moved back up to 0.96. They've actually issued an update on this, saying that it's the weekend, banks are closed, and on Monday, there should be sufficient capital. So you can see here the TLDR, too lazy didn't read. USDC can be used 24/7, 365 on-chain. Issuance and redemption is constrained by the working hours of the US banking system. USDC liquidity operations will resume as normal when banks open on Monday morning in the US. As a practical matter, our teams are well prepared to handle significant volume built on strong liquidity and reserve assets discussed below. So, obviously, it can be assumed that everyone is panicking, especially people with millions or tens of millions or hundreds of millions of dollars in USDC, who might be looking at losing multiple percents, or even at that point, we're down 13%. Imagine you have $100 million, that's $13 million potentially if it were to depeg. What if it drops even further? So even if USDC repegs and all the money is there, I think this causes a massive shake or a massive hit to the trust in USDC, and people who have this stablecoin are probably going to think twice about keeping it. So if there is the chance to be able to withdraw and redeem that money at a one-to-one, I think we're going to see a lot of people do that, and that is obviously can result in billions of dollars in withdrawals when this opens again on Monday. So things could get interesting, but hopefully the money is there, and obviously they're a business, so they make money. So even if they have to take a bit of a haircut on some funds that they may have lost potentially in this SVB bank deal or this saga, what's going on there, then maybe they can cover it out of pocket. And that is basically what they've said. And ultimately the point is here, Circle, as required by law under stored value money transmission regulation, will stand behind USDC and cover any shortfall using corporate resources involving external capital if necessary. So they're basically saying whatever happens, even if there is a loss from the capital at Silicon Valley Bank, then they will do whatever they need to do, whether it's from their own profits, their own resources, or raising more capital to be able to back that and make customers whole. That seems to be what the situation is right now. And according to this tweet over here by Avi, he's basically saying that the balance is over here in circulation versus the reserves. He's basically saying USDC has 11.4 billion split between 7 banks. 2 are SVB and SI. Bank of New York Mellon likely holds the majority of the assets. So even if 20% is an SVB and the haircut on SVB is 92%, then backing of USDC is cut by 182 million, which is easily absorbed by Coinbase Circle balance sheet. So just moving over to this, the implications from the USDC crisis are both negative and positive. This is a cool tweet from Andrew Kang, who's sharing his thoughts over here. Basically, the negative, the downside of this, stablecoin supply drops as holders diversify risk. It's basically what I said. A lot of people, even if everything does go back to normal and funds can be redeemed, people are going to withdraw their USDC because they don't trust it anymore after this. I mean, why would you if this can depeg by 10% or 13% or potentially even more? You know, why would you take the risk, especially if it's not your money, if you have a fund or if you have shareholders or anything like that? You're going to want to reduce risk, okay? DeFi and CeFi liquidity will be reduced because, again, if people see this risk with USDC, they're going to think twice about using it for pools, indexes, and liquidity. So that is obviously going to drop there. Overall net outflows from crypto and sideline capital because, like I said, yeah, they're going to reduce their investments potentially in crypto and just take it out until there is more clarity and more certainty and more security. USDC security risk if balance sheet is used. Okay, the good thing about this is surviving a bank failure proves USDC hardiness. So if this all ends up playing out well, then you know it's a win for USDC in a way because they survived a bank collapse and they're still fine and they still back the USDC. USDC establishes backup financing plans for future emergencies. So basically what doesn't kill you makes you stronger, and they will probably take measures to make themselves more resilient to any future potential crisis or similar situations. And some other issues that we're seeing here is that Blockfi, once again Blockfi, they just make bad decision after bad decision, or they're unlucky, whatever you want to call it. They have 227 million in uninsured funds in Silicon Valley Bank. So Blockfi has already taken major hits last year. If they're going to lose more of the money that they still have, it's pretty bad in my opinion. This is obviously still a developing story, so we're going to find out over the coming days and weeks what is all playing out. Apparently here it's saying that the SVB Bank CEO sold $3.5 million in shares before the collapse, and that would obviously be something that is going to get a lot of lashback because, you know, if the CEO and the insiders are selling because they know their bank is insolvent, that's insider trading, right? So that's a developing story still, what's going on over there. Then on top of everything that's happening over here, a couple days also ago is that we had the New York Attorney General Letitia James has become the first regulator in US to claim in court that Ethereum is a security in a lawsuit against exchange KuCoin per Blockworks. So basically what they're saying now is that Ether is a security in the KuCoin lawsuit. This maybe technically could end up being true after they switch from proof of work to proof of stake with their staking rewards. So that's another thing that we're going to have to watch out for and see how that develops. Basically, it seems like from all angles, crypto is under attack. The stable coins are, the SEC is just going after people. It's messy, okay? Regulation is coming. And this is something that we probably could have expected for a long time. After the Luna collapse last year, in May last year, what happened there, it's just a given that we are going to see more regulation. Governments, authorities are going to start looking into these things, start making rules, start cleaning up messes, and this is going to take time to play out. But again, like I showed you at the beginning of this video, the charts were pointing to all of this that came out after the charts were already warning with that bearish divergence that a local top is potentially in and that we're looking for a more downside. So now that I've caught you up on all of this, let's head over to the charts and let me share with you my thoughts on how I see that technically, because as I've shown you here, the news comes out after the fact. So this is what I'm looking for in the charts. So 2 weeks ago on this channel, you can see over here, I made this video called My Next Bitcoin Trade. Here is the setup. You can see over here 2 weeks ago. I will link to it up here also and in the description down below. And this is why I say the charts lead the way and then the news followed. So let me play this real quick for you, then I explain it, then we go look at the charts. Which would be a very nice trade that you could even potentially take with spot. You could also take it with leverage trade, obviously, if you know what you're doing. And this is potentially the setup that I'm looking for. It will take some time to play out. If we're looking at this before it gets down there, we're probably looking at 1 to 2 weeks. So you can see here from the chart, we were basically trading at $23,000 when I made this video. I was saying this is a potential range. We are in the middle. We're not looking for a trade here in the middle. And we're looking for a sweep over here of these lows. You can see here on the left and then a reclaim of the range and continue higher. I've also been saying the 3-day 50 moving average, which is about 19.5k, that needs to hold as support. Got both of those things, okay, as you will see in a second. So I was looking for a sweep of the lows, then a reclaim of the range, and then potentially continuation higher, and take out these highs at the top of 25.2 again. So here's the Bitcoin chart. This is a 4-hourly chart, and as you can see, we indeed dropped to 19.5. It's pretty nuts how that works. I'll show you in a second also how that combines with the 3-day 50 moving average. Okay, so we have this range. As you can see over here, we got the sweep of these lows. Okay, that's what I was looking for. We have this range. We drop below it, and not just a wick, we got a proper deviation. We got a lot of 4-hour candle closes over here, and as you can see, we're about to re-enter the range. Now, if you watch my tutorial on range trading, I'll link to it up here and in the description down below. Basically, you look for a sweep, reclaim of the range, and then potentially targeting the top of the range over here once again. And that is still potentially the setup. If we didn't know what was happening in the news, we didn't know about the banking collapse and all the potential chaos over there, just looking at the chart, this would be a setup that I would be looking to take because the risk reward is good. So basically I would re-enter on a reclaim of the range roughly about here. Obviously, if you were watching the lower time frames, it could have been a better entry at a 19.6, 19.5. If you got that, well done. The safer one is now wait on the reclaim, and the stop is at the lows over here, and we're targeting potentially these highs, which is something that even if it were to play out, it's probably going to take weeks before it gets back up there, maybe by the end of April, maybe in May, if we are lucky. And because this is a trade, you can see it's 1 to 5.6 if this works out in this way, meaning that even if it's wrong 4 out of 5 times, it would be profitable. And usually these setups with ranges are more right than wrong, and it just is a profitable setup. Of course, if you're trading with leverage, I would be only risking 1% when wrong. So if I get stopped out, it's not the end of the world. I lose 1%. If I'm right, I make 5% or more. Okay. What's interesting to note here is that also this pullback is exactly to the Fibonacci golden pocket you can see over here of this entire move. And what's even more interesting is if I change it to the 3-day chart, you can see that the 50 moving average here in blue is exact confluence here with this Fibonacci golden pocket. And you can see that is what I've been looking for. If you go back on my videos for the last couple of weeks, I've been saying as long as we are above the 3-day 50 moving average, if that holds, the bulls are still okay, because this is what has happened in the past. Because as you can see over here, just go back on this chart, do it yourself, create a chart, go to Bitstamp, 3 days at the 50 simple moving average, and you can see here when we reclaimed it, we stayed above it, and we eventually retested it again. Okay, it doesn't always go straight up. It tested it again and it launched over here. Even in May, or actually after the May crash in August, we got back above it, had a nice little run. It dumped, but it retested the 3-day 50 moving average and then had another leg up. In a similar way here, we got above it, we spent quite a few weeks above it, and now we are retesting it. So from a technical perspective, as long as this holds, this retest is perfectly okay. And actually at this point of the retest, it is the maximum risk reward in terms of taking a long position, because you could use this 3-day 50 moving average as invalidation. Basically, a bounce on it, touching it, which was 19.5, which is exactly what we got. You could take a long position there. If we get a new 3-day candle close below this moving average, then I would be looking to cut it, because we could potentially be going lower and we could retest the lows or new lows. That is a possibility. But if this ends up holding, you have a tight stop and potentially a continuation of this bullish trend where we could still be looking at 28,000 or 32,000 or higher if this ends up playing out in the same way as it has in the past. Okay, we're purely looking at the charts. It's no opinion, because if you look at what is happening in the news and you see banks are collapsing and all this stuff is happening, sure, it could be terrible. It could result in a massive crash, sure. But emotionally, that would make you think, oh, everything is going to zero. And as you remember, the FTX collapse was the same sentiment. Maximum fear is usually points of maximum opportunity. Now, who knows what's going to happen next week? Maybe everything crashes, but that's why you have a stop loss in place. That's why you manage risk. And if you're wrong, you're wrong. It's okay. You know, with the 1 to 5 risk reward, like I said, sometimes you get stopped out. It's okay. as long as it works more than 1 out of 5 times, you're going to be profitable with this setup, no matter if you get stopped out on certain occasions or not. Okay, so this is how I'm seeing the charts. This is important for me. A new candle close, body close below the 3-day 50 moving average, and I would get cautious with any long positions, and we could be looking at more downside, a retest of the lows or new lows. But as long as this holds, and this actually means we could get a wick below this, right? Even if it wicks below, as long as we don't get a close below it, it could still be bullish potentially, and we could be looking at continuation. Because while there is that threat of maybe there's more bank collapse, maybe there's more contagion, maybe there's more fear, and yes, maybe everything flash crashes, there's also the other opportunity where the central banks step in and they say, okay, we're not going to let everything crash. We are going to stop raising rates, maybe start cutting rates. We're going to provide bailouts. We're going to backstop any banks. And then everything massively pumps next week. That is also a possibility. So as with anything, I think the best thing is always you have to manage your risk. You have to know in the worst case, what is the most that you could lose, and you have to be okay with that worst case scenario. But you also have to understand what is the potential upside. If it's a good risk reward, if it's a proven setup, then it's up to you if you want to make that decision to take it. That way there's no emotions involved, and it's a purely calculated mathematical decision if you want to get involved or not. If you are worried about whether everything could crash, if you have too much invested, if you're overexposed, you should really reconsider what you're doing, and you should make a plan that you manage your risk, that even if everything crashes next week, that you're going to be okay. You can't be overexposed, especially in these market conditions, because as you've seen, something can happen overnight. The market could drop 20, 30, 40% here in the crypto space. Okay, so that is a possibility. You have to be prepared for it. But at the same time, if that happens, again, remember what happened in March 2020. We had that massive crash, that massive sell-off. Let's look at this over here. This happened very quickly. Then QE started, the money printer started, and we had a massive bull market, right? So even if we do get some sort of flash crash, even if there's more failures, even if things go down a lot, if we then get the Fed and the central banks to step in and print more money, we could see another massive boom in risk assets after that too. So this was a bit of a long video, but hopefully it caught you up to speed. I will be doing more videos again next week, so make sure to subscribe to the channel if you haven't done so. Smash the like button, leave a question in the comment box if you have any. And as always, just manage your risk, try to remove emotions from your investing and trading process, and that way you can make better calculated mathematical decisions that are more likely to result in profits. Thanks for watching. I'll see you in the next video.